slower, get some customers first, and then raise capital later.
Are you finding that entrepreneurs and companies have expectations that are not aligned with the market? And if you do, how are you educating them?
Just tell them they're crazy. We ask them what their valuation expectation is, and sometimes they'll throw a number out and give me a 5-year pro forma where they're going to be doing 100 million in revenue and making 85 million in EBITDA. And I say, there's a 0% chance of this happening, right? And they argue with me. But I think the market tells you what the valuation should be. It's not up to me or up to them. It's really the market. So I always encourage companies to talk to as many people as possible, get as many eyes on it as possible. And a lot of times they got to find the right investor for the right company. And if a life science company is beating my door down, they're in the wrong football field. They need to find people that fund their business. So finding the data for investors is very important. You can find it on Crunchbase. You can find it on the internet and find which companies, which venture groups are funding certain areas. Jim just had a company that came out of his network that got funded by Sequoia as the lead. So you have to, I think, look for companies that are funding that specific area. There's a lot of medical device in Phoenix, and I don't think there's a lot of venture groups in Phoenix funding medical device. So they just got to go outside of Phoenix, and the best ways are through attorneys like yourself, accounting firms, and consultants, and guys like us, like Jim and I can give plenty of referrals for venture groups that are doing either pre-revenue, seed rounds in areas that we don't really focus on.
Justin, we heard a lot about what Todd and Jim said in terms of where companies in Arizona are raising capital. Are you agreeing with what they're seeing? What are your thoughts on that?
Yeah, I absolutely agree. I think that our role as a broker-dealer is a little different than the venture capitalists. Most of the funding that we're bringing to the table are either retail investors or larger like qualified institutional buyer types, family offices. So there's a little bit of a difference when you're raising capital from a venture capitalist versus a retail market. But I agree with everything that was said. Seed funding is very difficult. From an investor's perspective, it's very binary. You either win or you lose. Usually when you win big, but more often than not, you lose your entire investment. So investors are much more prone to look at companies that are hitting the growth stage, and that's where you're much more likely to get some capital. I would say that the only caveat to that is on the real estate side. The projects really have more to do with the team that's leading them. And if you have an experienced team with a history of success in various projects, you may be able to get funding, for acquisition and development, prior to actually, operating the business and making, a stream of revenue.
So Nick, you're sort of an outlier in terms of the sources of capital that you're drawing from, whereas Justin and Todd and Jim are dealing a lot with venture capital firms, family offices, accredited investors. You're really focused in part on raising money from investors who are not traditionally active in that space. For the folks in the audience that don't know a lot about the crowdfunding process, talk about how that works and how what crowdfunding does and what your portal in particular does is something new that hasn't really been offered traditionally.
Thank you. So usually when people come to us, they've not really raised money before and they need a lot of help. Matter of fact, they could come to us with a good idea on the back of a bar napkin, having never used a disclosure document, a private placement memorandum. They've never aligned with anybody with real skill sets. They've never had a CFO really review their projections. So we start asking some probing questions. How did you arrive at these projections? What does that business plan look like? Where are you in this process? And so early on, what we're doing is we're trying to give them as many resources as humanly possible to get them to the point where they can actually raise capital. So we are a very early stage, and it's been very difficult to help these companies. But the beauty in what we do is that we do give them hope in the fact that they usually are pre-revenue, and if they follow our Fund Ready 10-step process and use the governor's crowdfunding law, this is an avenue for them to raise early capital. Yeah, that's what we do.
So you've taken technology and really allowed that to connect investors with projects. How have you seen technology change the way that money is raised here in Arizona?
Well, it's, digital finance at its finest. What our technology does is allow an entrepreneur to put their project on our portal. It's a deal page. It talks about their management, their key considerations, the offer itself. There's a place there for them to put a video, a pitch deck, photos, their disclosure document, escrow agreements. Investors from around the state can go to our portal, hit an Invest Now button. It takes them through the process, a 3-step process, to move their money into an escrow account that we currently have at Alliance Bank. Once the entrepreneur gets to the total of their raise, if they're offering equity, they got to get to 80% of their goal. If they're offering debt, they got to get to 100% of their goal. We help them manage that process, but it's all automated. It's all handled for them. So it takes a lot of work to get a company through that early phase and ready to go on the portal. But once they're ready, they have a clearly defined plan. They've got a complete disclosure document, several of which you've helped us with. And so it's a neat process to raise early capital.
Justin, you've been involved in the online capital formation space very intimately. Have you found that it's growing? Do you think that it's a trend? Do you think it's niche, or do you really think that this is here to stay?
I think it's here to stay. I think that the ability to reach a larger audience through marketing is something that significantly reduces costs for everyone involved. It's mainly lead generation, but the more people that can see what you have to offer, the more people that are likely going to be interested in it. I think also that, especially Nick, with a lot of the stuff you're doing, and a lot of the businesses that are more consumer oriented, you can kind of bake in your investor marketing plan with your consumer marketing plan, so you get a pretty big bang for your buck. You get the general market aware of what you're doing. I also think that the tools that are available through social media to kind of identify your target audience have significantly improved just over the last 2 or 3 years. So you can kind of design your ideal investor profile and target those people, and you can tweak it on an hourly basis, a minute by minute if you want to, if you're not seeing results. So you have a lot of control over who's viewing what you have to offer. The other thing that I would mention is that even if you're an Arizona-based company, your investor base isn't limited to Arizona. So if you approach this the right way, you can reach a nationwide audience. And the numbers are a little bit hard to get at, but we think Arizona has about 800,000 accredited investors, but nationwide you have somewhere around 40 million, somewhere between 30 million. What's the number, Anthony? You remember? Oh, 8 million. I'm sorry. Much smaller than I said. But so I think we're thinking, okay, anyway, so you have a much bigger audience nationwide, and you can reach that audience through digital marketing.
Jim, you're in the space with accredited investors. Unlike Nick, where he's sort of presenting deals to investors, you have to find your deals. How are you sourcing those deals and investment opportunities?
Well, we're in Arizona, so we have to do it in a lot of different ways. So the first is that we encourage people to apply to us simply by going to our website and filling out some forms and posting them. If we were a VC fund in Silicon Valley, they may have a place where you can do that, but it goes to nowhere because they're not interested in acquiring more candidates. They're interested in being very selective out of an enormous population. We don't have that enormous population. So we want to ensure that it's possible that we get to see as close to 100% of the interesting deals as possible. So first off, we make it easy for anybody simply to come to us and apply. The second is that I spend a lot of my time reaching out to people to talk to entrepreneurs, potential candidates to fill out these forms and apply to us. 94 other people are doing the same thing because we're all in the business of evaluating opportunities to actually put money to work, and you can't do that unless you have opportunities.
Todd, are you sourcing them the same way, or do you have a different strategy?
Yeah, again, we're geographically focused in 4 markets, and our box is real small, so we look for companies that just are either at that $1 million recurring revenue or a little before. So for us, it's I would say we probably give term sheets to less than 5% of the companies that we see. But for us, it's trying to find all the potential deals that fit our box in these markets, and that just takes a lot of networking in those 4 markets with our referral sources. And you know, we're mostly self-funded within our group. We have very few LPs. My partner and I fund 63% of the 15 deals we've done, and then the other percentages from family and friends and LPs that we have. But I'm real interested because I've been reading articles about these IPOs that have been happening, either self-directed or sponsored IPOs, less than $10 million. And I've seen quite a few of them that have been successful. And I'm really curious because I know that used to be the market back in the 90s and 80s. You know, my company I took public, we did a $4 million IPO in 1993, and $1 million of that went to me and my partner. And so it was a $3 million IPO for the company. And those were pretty common back then, NASDAQ small cap IPO. Now, you know, for years it didn't exist, and now they're back. So I'm really interested in that market. It's sort of a hybrid between crowdfunding and the public markets, and I think it helps the company on their product side, on the revenue side, and it also gives them more exposure to investors as well.
So when you're looking at a lot of companies, you're kicking a lot of tires, and you're only putting term sheets out for a few companies. If somebody that's watching this panel thinks, I'm at a revenue page where I want to start raising money, maybe start getting some venture capital suitors, what advice would you give to them to prepare for a capital raise?
Well, I would first hire a good corporate securities lawyer. A lot of these folks are using their family, friend's attorney or more of a generalist attorney, and I think you need to use a corporate securities law firm. That's first and foremost. I would encourage them to hire consultants and mentors. A lot of companies try to do it themselves, so hiring mentors, and there's a lot of folks, and that's one thing about Phoenix is I think people are willing to help, even if it's not a fit for them. Like 95% of my meetings, we're not going to fund that business, but we're trying to help them and give them direction. So I think this town is very open to helping. Where Silicon Valley, you probably can't get a meeting with a lot of people that you want to talk to. Here in town, you can get meetings with anybody. And I would encourage them to get mentors, consultants, good attorneys to help shape the business, vet out what is possible, what's not possible. And a lot of times they come to the conclusion, we're not ready to raise money, or we need to pivot the business a little bit, or I need to quit my other job and focus on this full time. And the group I met this morning, he has a full-time job with a big marketing agency. And I told him, no one's going to give you funding unless you commit to this full time. You can't be doing that 50% of the time and this 50% of the time. No one's going to want to fund that. So I think a lot of it's just having people in town help you get to a point where you can raise capital. Because a lot of these people are first-time entrepreneurs, first-time CEOs and founders, and they don't know what they don't know. So try to get some help.
Justin, what are you seeing there? Do you find similar challenges, and then what would you advise to a company that was thinking about maybe engaging a broker-dealer or doing a capital raise?
Yeah, I see the same thing. I think that in a lot of cases it does have to do with in early stage companies I'm speaking of, it has to do a lot with the founders, and maybe the management experience that they have. Or, in some cases, there's holes in the management team that need to be filled prior to any chance of raising money for the company. There's also the piece that was alluded to regarding, the securities attorney and, kind of working through the documents that are required, thinking through your cap stack, thinking how you need to structure your deal. So all of that, there's a lot of factors that come into play on whether or not a company's ready to raise capital.
Jim, what are you seeing? What are the big do not do's for a company that's thinking about trying to get investments?
So actually, I think the very first thing that any entrepreneur really needs to think about is not just the money. Because some people think, oh, I'm angel backed or VC backed, man, that's really cool or sexy or whatever. And that's not really the point. The first question I think any entrepreneur really needs to think about is about control. There are some people who have a model of, oh, I'm great, somebody's going to give me their money on day one, and I'll give them their return in 3 years, and they're going to be real happy. And between day one and happiness is for me to decide. And that's actually in one way okay if you don't want to give up any control, which is a requirement. Some control is a requirement for outsiders putting money into your business. If you don't want to give up control, grow the business as you can. The earlier panel talked about bootstrapping. We can talk about organically growing your business. You can use other words like lifestyle business. They're perfectly fine businesses. If you don't want to share control of your business with other people who have a stake in it, you're not going to raise any money from outsiders, because we as outside investors, typically putting a lot more money into the company than the founders have done, want to protect that, which means we're going to want a seat on a real board of directors. We're going to want to have a properly constructed board of directors so there's real decision making, that is not only what the CEO wants to do. So it's a first question, and we talk about that right away. If the founder says, give me your money and come back in 3 years, you're gone. The second issue is if you think that you're the kind of player who can do everything, which is tantamount to being the quarterback who throws the pass and runs downfield to catch the pass, we're not going to be investing in you. This is a business is a team sport with position players who are expert at those positions. And if the founder or the two founders don't understand that they need a lot of people in their businesses to be as good at what they're not good at as they are what they're good at, we see that as a non-starting business. So we look first and foremost at issues about the self-awareness of the founders as to who they are, what they want out of their business, and how they're going to run it.
So when you have those conversations about control, and for somebody that's watching the panel and has never had outside investment, what type of controls or safety measures are you looking for as an investor, and what should a founder expect to be having to give up to take that money in?
Well, the first bit is a board of directors. We see a surprising number of companies that come to us. There is no board. There's just two founders. And hey, we've got this really great idea and we want your money. But the notion of a board of directors is that the board, which would be, we think, 5 or 7 people, some of whom are from the founders and some from the investors and some who are just know the business, can make informed decisions on directions to go, because businesses have to pivot. The first idea is most frequently not the one that ends up being the business that works, even if it's extraordinarily successful. So how do you figure that out if you only know what you know? It's with other people who really care about the outcome. They're going to put their brain power as well as their capital to work to make it a success. So it's about the sharing of those sort of notions of how to run it. If there are outside investors of a meaningful amount, they're going to want to have a seat, sometimes two, but a lot of it is really to bring other people who may not even have a stake in the company but want to see it succeed. So it's a board that makes decisions on compensation, makes strategic decisions, makes decisions on capital raising, all those fundamental things that you do with a company that may have no revenue or $800 billion in revenue.
Todd, would you expect the same thing going into an investment? Are there certain things that are deal breakers for you?
Yeah, we have all the standard minority control provisions in our documents. So they need our approval, the investors' approval, to raise more money, to hire a C-level executive, to raise debt, to sell the company, to make an acquisition. We approve the budget every year. Our right is to approve the budget. So we let them operate the business day to day, but the big things, those things that I mentioned and some others, we need approval on. And I think most founders understand that. There's some founders that walk away. We had a term sheet on a company, and the guy, I heard him talking about buying a new car and having a jet card. I said, no, you need board approval for stuff like that. And he's like, what are you talking about? So sometimes they're just oblivious completely. And that guy walked away. He didn't want someone breathing down his neck on how he spent his money. And we've walked away from probably 6 term sheets over the years where founders wanted a lifestyle business, but they also wanted the capital. Mm-hmm. They weren't willing to give up the lifestyle type of things in the business, the country club memberships, the credit cards to support their lifestyle. And like Jim said, it's a different game. When you're taking investors' money, you have fiduciary responsibility to them and the board to run the company as a fiduciary, as a prudent executive. And a lot of founders don't get that. They just don't get that. They've never been there before. And I would say half the time, the founder is not the CEO in 3 to 5 years. A lot of times that person is just not cut out for it for a number of reasons, and the board will find a new CEO to replace that person.
So, Justin, Nick, Jim and Todd are coming at it from a perspective of there's usually one investor or they're the lead investor. In an online capital formation environment, often there is not a lead investor and your investor group's fragmented and nobody has any particular leadership role in that group. How are you seeing online capital formation differ from some of your traditional angel investor and venture capital formation when it comes to the types of controls that are being imposed on the founders and what founders can do with the business?
I'm completely different because the entrepreneur actually takes the time, works on a disclosure document. That disclosure document determines what the entrepreneur is going to be doing, use of funds, what the remedies are, if there's personal guarantees, how did they arrive at their valuations, what did those projections look like, how did they arrive at those projections, and the investor, the single investor, has to take it or leave it. They don't have the luxury of negotiating. It's the offer is made and it's either accepted or denied.
Are you seeing the same thing, Justin?
Yeah, I think the venture capital world is obviously a lot different than the retail world. That being said, I agree with everything that was said. When the types of deals that we work with are private placements to retail investors, and there typically is not a lead investor. That being said, the offering documents are very specific on the use of funds, and it's a crime to violate that without especially without disclosing to investors. So that's number one. Number two is every situation is completely different for us. In some cases, we are taking a seat on the board, appointing somebody, a trusted advisor to the company. And that's part of the use of funds for the raise, or a management team. So we do take a close look at what is, especially companies that are, in very early stages and have inexperienced leadership. We're taking a very close look at that prior to, agreeing to raise any funds for that company.
With a control investor, although they do impose some controls though, unlike maybe in crowdfunding where Nick has a lot of investors, maybe they do or don't have experience in the industry, ATI, Canal Partners, they bring value in addition to the money that's being invested. Could you talk a little bit more about that and how that differentiates you from maybe some other sources of financing? I guess for Jim or for Todd.
Yeah. If we're putting in a relatively significant amount of money, and relatively significant means if the founders have $50,000 or $30,000 in the business and we're writing checks for $500,000 or $1 million, that's relatively significant. And we want to protect our investment. You know, we're making judgments not just at one time on some founders. So we look at this as if our money's going to be working to make a startup business into a much bigger and much more valuable business, what else does it require to get there, and how can we help make that happen? And with 95 brains looking at each situation, we've got our own expertises and the expertise of the contact databases that we have that extend into the thousands. So we look for opportunities to bring smart people to bear on the companies. We open up our contact databases. I looked at a company that we're looking at right now has a product that could use the raw materials that are produced by one of our portfolio companies. That was like an instantaneous introduction. Both people benefit. So we do that all the time. But we're also looking for people who have domain expertise. You know, in the startup world, this is about doing things that have ideally never been done before. You need people who know what's been done before and how people buy. Customers are ultimately the issue here. That if they understand how customers are going to react, they can inculcate that knowledge into the founders so they can go out and actually make the kinds of sales that are going to make the company a success. When sometimes the founders' experiences have been entirely different and never had to sell into that sector before. So we look at it as we add intellectual capital as well as dollar capital going into a business.
So Todd, you've got your finger on the pulse of the fundraising industry generally in Arizona pretty well. What trends are you seeing now that maybe weren't around a few years ago, and how do you think that's going to impact the environment?
I see the bigger firms coming down market. If you look at feet on the street in Phoenix, you have a lot of billion-dollar funds that now have people coming to Phoenix on a monthly basis. You didn't have that 5-10 years ago. I would say there's probably 3 to 4 dozen billion-dollar funds that have representatives that are down here once every month, if not even more frequent. And they're going down market. They're looking at funding companies 3 to 5 million in revenue, where 10 years ago they might have been at 20 million in revenue. So it's gotten much more competitive. There's a lot more capital than there was 10 years ago. And so it's really easy for companies to raise capital once they kind of hit that $3-4 million in revenue. It's just getting from that 0 to 3-4 million, that's the tough part. And they got to pick the right partner. They got to pick the right partner that's going to be supportive. We've done 3 follow-on rounds this year from our portfolio companies. If we didn't do that, those companies are out of business if no one else stepped up. So I think it's important to have the right investor that will continue to support the company until they can get to the point where they have 3-4 million, 5 million in revenue, where they can get outside capital or outside of us. The other part is what Jim was saying. We help companies wherever we can. And a lot of it's referrals for customers, people within the organization. But a lot of times we play psychologist in the business. We're on the board, and we try to get the CEO and C-level people to see their shortcomings. And a lot of it's just playing therapist and try to help them where they have shortcomings. And sometimes the CEO will say, you know what, I'm not the person. I need to step down and let's go hire a CEO. It just happened with one of our companies that's doing very well. They're growing 15% month to month. And the CEO made that decision. We went out and hired a CEO that was CTO of GoDaddy from 20 million to 270 million of revenue. And we found that person for that company. And other times the CEO can't see his shortcomings, or he or she can't see their shortcomings. And once in a while we'll have to forcefully remove that person. But we're not willing to lose all of our money because of personalities and a block from the CEO. And I think that's the difference between maybe retail investors or crowdsourcing and or passive venture capitalists and us. We're very active. We typically invest, we have a minority position, 20 to 30% of the business. But after subsequent rounds, we usually get into a majority position. So we look at it like if we're in the majority, 51% or more, it's really our business. And we're not willing to lose our capital and walk away. So we'll do whatever we can to make it work. And a lot of times, it's either pivoting the direction of the business or it's replacing the CEO. We don't want to run a business day to day. That's the CEO's job.
So when you see more money coming in from outside sources, do you think that's because the Phoenix market itself is changing, there's more targets, or do you think it's because there's more capital out there, there's more competition among the venture capital firms, and they're forced to look where they didn't used to look before?
Yeah, there's more competition.
Yeah.
I think there's definitely more companies that fit the build here locally, but that goes with the economy. You could say that about any city. You can pick Charlotte, Miami, Atlanta, any city, and they have the same experience. There's just from 2008 to today, there's just a lot more growth in companies, in startup companies, and just picking the numbers, a lot of those were going to bubble up and succeed to get to 1-2 million of revenue. So I think it's just the market on both startups and the market for capital, venture capital. If you just look at the amount of capital that is put into private equity and venture capital in the last 10 years, it's grown 4 times the GDP rate. So it's just a lot more liquidity right now in the market.
So I think we're about out of time. Before we wrap up, just going on the line, if you could give one piece of advice to somebody out in the crowd that's considering a capital raise, what would it be? Nick?
It takes money to make money. If you're even coming to me with a good idea in the back of a bar napkin and you can't afford a securities attorney, some marketing, paying for a CFO to review your projections to make sure that they're in concert with the industry you serve, chances are that's a non-starter. So you got to have some money. And when it comes to making an offer, the investor needs to make a fully informed investment decision. And that's part of the service that we provide, is just to make sure that the investor can make that fully informed investment decision. And if you're interested in using crowdfunding, you can come to our portal, fundmybusinessaz.com, and hit the Raise Capital button, fill out a one-page form there. We'll take a look at that and see what resources we can help you with.
I think I agree, and I would add to that it's important to have an open mind. It's important to listen to feedback. There's people here that have been, that do this for a living, and our evaluations and critiques are many times, pretty valuable, and be open to what we have to say.
I would say make sure your company is solving a real problem. I see a lot of businesses that they're solving a problem that doesn't exist or is not that big of a problem, and understand your market. If you're going to build a big business, you have to understand your market, your competition. I've been very early in deals, and I've been very late in deals is in terms of the market, and timing is everything. If you're funding something, I remember seeing some great tablets from Dottie Hall years ago, 20 years ago, and it was just way before the tablet market was here. And those companies failed, and they lost hundreds of millions of dollars in that space. Now the market's here, and that market is thriving. So I think timing, making sure you understand your market, and making sure you're solving a problem that's significant to businesses or consumers.
And my advice is fundraising takes a lot more time than you think it will do. So if you're considering raising money, start early, which is another way of saying don't run out of cash. And there's a very simple, very practical way to look at it. If you're raising money and you come to us and we say, well, how fast are you burning your money? And let's say we're spending $15,000 a month. And then I say, how much money do you have in the bank? And you say $30,000. That means you've got 2 months worth of cash, and 60 days from now you're going to be out of business. Is your business going to be worth more or less the day after you stop having cash? So from an investor's perspective, without being mean or anything, wait 61 days and then we can talk at a much lower price to fund you. That's not a good thing. So it's a very simple thing. If you want to think about raising money, start way early because it's going to take several months to accomplish.
Jim, Todd, Justin, Nick, it's been a great conversation. Thank you very much. Appreciate it.